So it's a pleasure being here. Thanks for making the space and having me here. It's an honor presenting this at the CFA, the sort of the gold standard of financial education. And I think that also epitomizes sort of the journey that impact investing has been going through. It has been sort of a really niche activity. Where we also, as a bank, in the bank, 4 or 5 years ago when we started, nobody knew us, and today we have become sort of a fairly well-known unit. We just are in the process of closing our last fund at over 500 million. So impact investing is gaining size; it's getting serious. With that, so I see a few familiar faces. So I know that this is a very heterogeneous group. Some of you have had no exposure to impact investing. Some of you are teaching in Harvard. Some of you are consultants. So I will take it really, this speech today is really as intended as a 101 introduction. What is impact investing? How is it defined? How does the landscape look like? How can you approach it? So really covering the basics, so to say. I think we are not too many people, so if you would like to ask a question, you're most welcome to interrupt me. So if we start with impact investing, what it is, at the very core of it is really the notion of including an additional axis or an additional element in addition to risk and return, which is the social element. And this is quite revolutionary, but if you think about it, the element of risk is a fairly recent phenomenon. In financial mathematics, it has only been included 150 years ago. The concept of risk itself was also the probability theory was only developed in the 17th century with the Renaissance. So, taking sort of a historical view on it, it puts things into perspective, and one additional element, one additional vector. But even that, even sort of including the social consideration into investment decision is not a new phenomenon as such. I mean, basically every every investment that we do has some sort of social ramifications. Unintended ones, though, and we can take any company we want. Let's think about Amazon, right? If we invest into Amazon, you may argue that there is a positive impact because Amazon delivers to handicapped people who otherwise, would have to go through the hassle of somebody bringing them out, go to the shop. You may argue that people can buy goods who live in very remote areas. But on the other hand, you can also say that, hey, Amazon is crowding out or killing sort of the local bookstores around the corner. And I think what differentiates impact investing from conventional investing, where there's always a positive or negative social impact in any investment, is that there is the element of intentionality. But even the intentionality, and I've pictured here the picture of a Frenchman who was teaching at the Harvard Business School, Georges Doriot, who is seen as the father of private equity and venture capital at the time. And when he developed the evaluation techniques that we use today in private markets, in private equity. And Georges Doriot was mandated after the Second World War, he was mandated to invest into small and medium-sized enterprises in Europe to rebuild Europe, to lift Europe out of poverty. And that was really the start of modern venture capital. And the way he called it at the beginning was actually development capital. So for him, the main purpose of doing that was a development purpose. So if I'm sharing the story just to put things into perspective, that the notion or the idea of impact investing is not so new, and perhaps also that it requires some mechanism of policing that these investments go into the right direction. So impact investing is investing with a positive, sort of with the objective of a positive social impact and a financial return. It is not philanthropy, so it's not about giving money away, it's not about losing money. You may generate sort of competitive returns, or even more than competitive returns, or you may have concessionary returns. But sort of what many people believe who approach the industry, that a good impact investing is a bad investment just because you take the social dimension into consideration, is probably a wrong assumption. So how do you create impact? So how do you create impact? Impact, you create it by two ways: either by producing goods or services for marginalized or disenfranchised populations who otherwise would not have access to it, or by involving these marginalized populations, whatever they are, either low-income populations or handicapped or whatever, into the value chain. It needs to be intentional, just to what I was alluding to before. It should not be it should be by design. And the social impact should be measurable and ideally also be measured. And we get back to that later, to the measurement bit. So there has been a lot of attention in the media around impact investing. And why is that the case? Why has there been so much attention around impact investing? Number one, because the needs are clearly rising. So social needs are increasing globally, and on the developing countries, today there's a huge discussion about sustainable development goals of the UN. How can we increase or enhance the state of humanity, and those succeed the Millennium Development Goals of Kofi Annan that had been stipulated 10 years ago, and that came to an end last year. And that basically, the first picture just shows how much, so all of the black, or sort of the dark color ones, is fields where we are seriously off track, despite sort of big and large government interventions. So there are clearly more resources needed to address some of the most pressing challenges that we have. At the same time, and that's under number two, in the Western world, sort of the traditional donor countries start to have problems themselves, right? We have decreasing budgets. Healthcare systems are, even in Switzerland, we have an asset liability mismatch of pensions, if we project it, of healthcare systems. So even in the Western world, in countries like Switzerland, we will not be able to maintain the social standards that we have and the social sector provision that we have today, and development aid will be decreasing. Then the question is, can philanthropy, what many think, philanthropy sort of giving money away, sort of grant money, can grant money compensate that? And the answer is no, it can't, because it simply is not rising fast enough. So new capital channels are needed. That's one of the motivations. On this motivation that's particularly motivation for many philanthropists, maybe not so interesting for you, is that the social sector, for various reasons, is fairly inefficient. You know, there had been a study by McKinsey in 2006 that says that NGOs have transaction costs of 22 to 43%, whereas in business it's significantly, it's a one tenth of it. I'm not suggesting that all philanthropy should be turned into business instead. That's not feasible, but sometimes business is more efficient in allocating scarce resources. And lastly, there is also, and this is most interesting for you, there's also a commercial argument why impact investing makes sense. The first one, and this is really about investing into megatrends, right? Impact investment or social problems are all about market failure situations, after all. And as you will know, good investing is all about capturing market anomalies and turning them into opportunities, understanding where does the broader market either overestimates a risk or underestimates the upside. And impact investing is typically in these looks at situations where there is a market failure situation. And I've just picked 3 of them that we as a bank believe in. So the first one is low income consumers globally. I'm not only talking about the third world or developing countries predominantly about those, but even in sort of OECD countries. Low income consumers constitute they produce more they consume annually more than 52 trillion of goods and services. I'm talking about the poor who have a disposable income, not about the poor who have no disposable income, who don't have anything, right? So 52 trillion annually, and that is rising. These people pay a poverty premium because the goods and services that they buy are not designed, are not packaged, are not priced for them. So they're not for them, they're for somebody else in terms of size, so they're paying a poverty premium. And there has been a professor at the Wharton School who passed away a few years ago, Mr. Prahalad, and he wrote this entire book at the bottom of the pyramid, where he was just, describing this phenomenon that low-income consumers pay this poverty premium. And one of the famous examples is, how do we buy the powder, the washing powder that we buy in huge boxes? But in poor countries, low-income consumers will prefer to buy it in little sachets for one or dual usage, right? Because that's what they can afford, that's how they can store it. That's one example. So there's a huge commercial opportunity next to the social one of tapping into these markets. And it's not only about consumer products, it's about finance, it's about insurance, anything you can imagine. The second mega trend that we see is sort of the transformation of the sustainable demand structure. And this you probably also know from yourselves, that sort of when I was a kid and I saw people recycling around me, it was more of a moral imperative. It's good to do it because it's the right thing to do. And it increasingly becomes sort of sustainability increasingly becomes also of an economic imperative. If we look at, we've conducted just within our client base, we've conducted a survey, and we've seen that sort of younger people will, up to the age of 37, are more likely to look at the packaging, like 2 times more likely, and are 5 times more likely to check the packaging. The ownership, sort of who owns something, is important. Ownership matters. So who owns something actually matters to them. So this is, and it's not only a question about millennials. Generally, people become more aware about sustainability, and the so-called LOHAS consumer group is one of the fastest growing consumer groups globally. And the third sort of mega trend is what I was alluding to before, the decline of the welfare state. I mean, you know, in looking at economic cycles, economies are going up, are going down, but generally the trend is there's less money available, and social sector provision, as we know today, will not exist in 15 or 20 years. And some of the public goods that we consider public goods today will be transformed into private goods or quasi-private goods. And then the question is, how can we design it in such a way that the delivery is as good as it is now or even better, and efficient. And we believe that all of these 3 mega trends offer opportunities also from an investment point of view. So those are a few hockey sticks from which basically goes into that direction of the megatrends of Ray Kurzweil from his book The Singularity is Near. Ray Kurzweil is, I think, the inventor of his most patents globally. He's the chief invention officer of Google, and he said that impact investing is basically smart macro trend investment. I wouldn't call it that way, but that's another way of seeing it. There's also a downside argument that many institutional-like investors, because of the public scrutiny, knowing that people will look at their institutions, have to be mindful on how they are invested. And that's another reason for going into, or motivation of going into impact investing. So how does the landscape look like today? It is a very small market. I mean, there are different estimates on how big the market is. It's probably somewhere around 120 billion large at the moment. If we price out sort of a certain US tax regime that allows foundations to invest some of their grant money, we are more at 60 or 70 billion of invested assets in impact investing. The sector is probably growing at an annual growth of somewhere between 11 to 14%. So modest to good growth from a fairly low basis. Most of the funds are fairly small, 25 million US dollars the median. There are about 400 companies that are rated by Gears, which is the company that is doing the rating. And there's a lot of commitment generally to invest in the future in impact investing. 48% of UK pension funds, for example. There are different reasons why this doesn't yet, sort of why the market hasn't taken more off yet, sort of, which are all sort of characteristic of a nascent market, but I don't want to get too much into details. the universe of impact investing generally, you can play impact investing through different asset classes, but in reality we are talking only about private markets at the moment. So we're only talking about private equity and private debt-like structures. And we see very, very little sort of public listed strategies, which may change. So what I would like to do is give you a snapshot. Obviously the time will not be enough, to go into all different styles in detail. But what I would like to do is go into 3 different investment styles that are very popular, that people talk about, just to give you an idea of what strategies are out there within impact investing. And the first one is without any doubt microfinance. Microfinance is the most mature, the largest, and also the most transparent impact investing strategy. And microfinance, some see it as a fixed income instrument, others see it more as a private debt and hence sort of an alternative instrument. Microfinance, maybe I can, for the benefit of those, it basically gives loans to people who are in the informal economy, who do not have an address, sometimes do not have an address, and do not have a collateral. And these people do not have access to finance and hence cannot finance their small businesses. And the whole idea came up in the 70s and then gained tractions in approximately 10 years ago. And the idea is that through a process by which a loan officer maintains a very close contact to these micro-entrepreneurs, sort of a social control through a loan officer who goes and sees them every day, or through a group control whereby I will not only lend to you, but to you and you and you, and then you control yourselves. Sort of the magic sauce here is social control. The repayment rate in microfinance has been astonishingly high. I think the non-performing loans are very low somewhere. I think historically somewhere between 1% and 2%. And as an investment side, so it had been conceived initially, to help these people finance their small businesses. But over the time, we saw that during the Asia crisis in 1998, Indonesia, for example, when most of the finance institutions went belly up, actually the microfinance institutions, sort of these microfinance banks, were resilient. We saw in the crisis in 2007 to 2009, we saw that while there was huge volatility in the portfolios, microfinance was fairly stable. And because of the Nobel Prize of Muhammad Yunus, who not invented, but sort of who was the most prominent face of microfinance, there was a lot of money. I mean, 30 billion is a lot of money for the sector, was flowing into microfinance, and that led to sort of a little bit of a challenge of absorption capacity. So fairly quickly, a lot of money into the sector. And everybody wanted to go to the most highly rated microfinance institutions, and everybody wanted to go for the most short-term loans. And this is, I think, as everywhere in finance, you need to adapt your strategy. What was sort of a winning strategy 10 years ago, today probably the opportunities in microfinance are rather in investing, equity investing in expanding the capacity of good microfinance institutions so that they can absorb more money. Or a good strategy could be to invest into the upscaling. Sort of, we are mainly talking about entrepreneurs from the informal sector. How can we help these guys and finance them to actually become small and medium-sized entrepreneurs? But microfinance has really paved the way for impact investing, and again, it's one of the most transparent asset classes. Another one is private equity, and private equity generally. But let me start with emerging and frontier markets or developing countries. If you take, I've spent a lot of time in Africa. It's difficult to invest into listed companies in Africa. There's a lot of, sometimes you only, if there's a stock market at all to start with, sometimes you only have 1 to 5 stocks. There's insider trading. Basically there's an absence really of a listed market space. Nonetheless, these countries are, the growth rates of these countries are very interesting. It's dynamic, young population, and so on and so forth. And the manager space of sort of the manager of private equity companies in Africa, for example, I'm just giving this as an example, has developed dramatically. I'm just giving the comparison between 2000 and 2015, and in most of these countries, you will have more than 2 or 3 managers. And one example, let me take a step back. Private equity is interesting from an impact investing perspective. Why? Because it allows you to, if debt is a contract, private equity is a relationship. And it allows you to shape and influence the course of a company. And especially if you're talking about impact, this is very attractive. So just picture the case of a pharmaceutical or of a pharmacy chain in sub-Saharan Africa. And this pharmacy chain is selling their drugs at 12 to 15 times cost. And with 12 to 15 times cost, you only reach a very, very, very small percentage of the population. Now, Africa is known to have globally the highest percentage rate of investment, sort of private investments on healthcare. If you come in as an impact private equity investor into that pharmacy chain, or fund, impact fund comes into this, they can gear them towards lower margin, bring it down to 3-4 times cost, but much higher volume. And this is why private equity is probably more transformative than debt instrument in the impact space, because you can shape the way that companies are working. Go ahead.
What sectors are mainly represented in those African funds?
So most of these funds are generalist funds, so they will not be pure strategy, pure play strategies, but that is changing as well.
Where do they tend to invest these days? Is it fairly broad, or do they?
It's fairly broad. It can be anything from, it can be healthcare, it can be education, it can be consumer products, it can be utilities. Fairly broad. I think where we see sort of the line is somebody, you have a lot of countries where the entire industry and the investment community and investment activity is around extractive industries, right? So Mongolia as an example, or Nigeria probably. So impact funds will not invest into extractive industries. I mean that's a part that's already working, and it's probably not part of impact. What you will see though, for example, in Mongolia, is that there's a lot of, migrant workers who are working in mines, but there's no real housing, or there's no real housing for the family. So it may be adjacent businesses around mining activities. But it's not the typical. So a typical, I guess this is where I wanted to go. A typical private equity fund that we get to see here will invest into extractive industries, and that's not what impact investing doing. And do you want to say something?
Yeah, I think in impact investing, what we see quite a bit is financial inclusion in Africa, so like mobile payments, and quite a bit of education, and again microfinance. And renewable energy, there are some interesting funds.
Yeah, financial inclusion, sort of both beyond microfinance, sort of also the microinsurance and so on. Yeah. So that is private equity, but private equity, I don't want it to be confined only to developing countries. We can also, there are interesting and very successful funds in France, in the UK, in the US that focus on investing into low-income areas, for example. And that are doing, by the way, also very nice returns. And by the way, without knowing that it is impact investing, Magic Johnson, the basketball player, he made a large chunk of his fortune by investing into low-income neighborhoods in his hometown, and basically not upgrading, not gentrifying them in the sense of, making it a hybrid, not at all. So it remained the same people living there, but sort of investing into the cinema, into the cafe next door, and make it sort of livable and create sort of an ecosystem, to reduce crime rates and so on. Good. Social impact bonds. This is still a very small field there's a lot of attention in the media around these social impact bonds because they're predominantly here in the Western world. And the idea of a social impact bond is that private investors pre-finance activities that usually should be performed by the government. And by doing so, they commit themselves to, and contractually with the government. So they advance it, they commit themselves to either do it cheaper or better, or ideally both. Okay? And that leads, and I will bring an example because this is very theoretical, and that ideally leads to some sort of welfare gain, and economically speaking, sort of a cost reduction for the government. And that cost reduction for the government is then the government shares with the private investors. And let me give you perhaps one example that we did right now in Israel. And this is about diabetes. So diabetes is a disease that, you have diabetes 1 genetic, diabetes type 2 lifestyle, too many burgers, not enough sports. And diabetes is in most developed countries, but increasingly also in developing countries, is a huge problem and a big burden to public finances. So there are direct costs for insurance companies and the state, but there's also indirect costs for gone work or other diseases that are caused because of diabetes. And why did we choose Israel? Because Israel is a fairly small country. The government was fairly open to discuss this, and the data situation is good. So the government, the Ministry of Health knows exactly if one diabetes type 2 case will on average create X amount of costs for the government. They know that. They also know that the prevention of it is politically very, very difficult. It's very difficult to convince political stakeholders because prevention always costs money. So that's a little bit the crux of democracy. You know, if you have a cliff and people are jumping down the cliff, you can always convince people to pay for the ambulance, but it will be more difficult to convince somebody before to build up the fence. So that's sort of the political arbitrage idea. So what we did together with a partner in Israel, as well as the Ministry of Health and some of the insurance companies, we created a vehicle that finances prevention activities. And those are very, very thorough. And the outlook for those prevention to work out are very, very good. I mean, there's been serious work going into this. And this vehicle also has a contract with the Ministry of Health and some of the insurance companies that if we bring down the diabetes from pre-diabetic to diabetic, if we can bring down that number by 20, 30, 40%, dear Ministry of Health, this will result in lower costs for you in the future. So the Ministry of Health committed contractually, together with the insurance companies, to share these anticipated cost savings with the investors who've pre-financed the activities. And you can think about that. I mean, you can think that in times of scarce budgets, you can think about many things where you could apply these mechanisms. No, I don't want to suggest that it's easy. It's very, very time consuming. It's not so easy to scale because, how do you, what is success? Translating a social contract into a financial model is different in Zurich than it's in Basel, leave alone in Israel to Switzerland or to India. But I just wanted to give one more example, and you will probably also read about it in the press because it's very prominent, the discussion around social impact bonds. So there are other exciting impact investing strategies. You were alluding to it in the field of technology, microinsurance, catastrophe bonds that insure smallhold farmers from drought or other catastrophes. I think at this stage is less a question of feasibility where impact investing opportunities can be structured, than more where is there already maturity of and experience and track record of managers. So so what I wanted to briefly touch upon is the double bottom line. Everybody's talking about the double bottom line. I mean, I was alluding to it in my in my introduction, sort of both a financial and a social return. Again, many people think that a good impact investing is a bad investment, or should be a bad investment. And there are two studies that have been recently conducted by the Wharton Business School as well as by Cambridge Associates. And both come to the conclusion that this is sort of in comparable asset classes, where Cambridge was only focusing on private equity, that it's not the case. If you compare private equity impact investments to the equivalent vintage of private equity, then it's actually not performing worse at all. Granted, both of these studies, sort of the observation, the number of funds that have been looked at, they're statistically significant, but they're not super huge, and probably we'll have to look at it over a longer time. But the first indications that we get are not so negative at all. And I can tell you that sort of from a personal experience, the return potential is out there. I think what most people, and I can see this at the bank, where I've a constant struggle, is that, as you all have learned, it's not about returns, it's about risk-adjusted returns. And most of the people will, sort of, for most of the impact investments that we talk about, we cannot price the risk. And or sort of the conventional investor community cannot price the risk. And I can give you an example. If we talk about microfinance, we were talking about before about microfinance. If we talk about microfinance in Bolivia, Bolivia has, according to Standard & Poor's, somewhere a sort of a sovereign default probability of 26-27%, last time I checked. So with that default probability, the return, be it in a debt or equity instrument, should be very, very high. And no microfinance investment will give you that return that, with that assumption, an investor would demand. Now, the reality, but if you understand the local risk, you know that Bolivia has probably, despite its very left-wing government, has probably one of the most robust legal framework protecting these microfinance or sort of inclusive finance institutions. If you know the statistical track record in the country, if you know that they actually have a credit rating agency for the institutions that are supervised, you know that for microfinance, Bolivia is actually a very, very good place to invest in. And if you know that the default rate is 1 to 2%, you would rather put it at 1%. So you end up with a delta of risk between 1 and 27%. So there's a mispricing of risk, and you know, as the industry matures, the better we will be able to explain the risk, and the better the returns will look like. So that's on the return side. On the impact measurement side, I mean, I think impact measurement is important because it's sort of the compass. It helps you stay going in the right direction, because otherwise it's very tempting, you know, to invest into some of these markets and just look at the risk-adjusted returns and not anymore the social impact. So it is an essential element of impact investing to track the impact, the social impact. But it's not easy. Why is it not easy? First of all, to start with the time. Maybe the impact that I'm generating with my investment today will only be visible in 10 years. So what's the real cutoff time to actually measure an impact? Can I, as with many financial instruments, can I really compare investments ex ante before I invest? And then I see in an investment committee, I sit and I say, okay, here I have these projections of returns. Here I have these projections of impact. How can I compare impact? Reliability or credibility. How have these systems been designed? There's a standard that has been established, but not everybody is using that standard, and that standard is by all means not perfect either yet. Incentive alignment. You can build up the best impact investing fund, but if the manager himself is not incentivized to look at the impact elements, you run the risk and that they will be sidetracked. We did that at two of our funds. We included incentive alignment mechanisms where sort of managers are not measured only against the hurdle rate of the return, but also against a hurdle rate, sort of a social impact hurdle rate. But that's hugely complex because you define a hurdle rate in 10 years. What's a good social impact for, in the healthcare space in Liberia in 2026 or 2022. And finally, and I think this is the most complex one, is costs. If we are all costs of impact investing has a cost. You need to design it, you need to measure it, somebody needs to assure or audit it. So all of that comes with a cost. And in an industry that is at any rate, in most instances, fairly subscale, I shared with you the number before that the median fund is somewhere between 25 to 50 million. Then additional costs have to be rolled over to investors. And in times where people complain about 220 structures, it may actually become a 2.5 or 3% 20 structure. So that's the problem of subscale combined with additional costs. I see that we're slowly running out of time, and therefore, I think just very quickly, there's a huge discussion about how do you actually do impact investing. Do you do it as a so most of the people who do impact investing sort of create a distinct bucket and say, okay, this is impact investing, and it's a little bit my R&D bucket, and let's see what comes out of that. And as it matures, we have, for example, developed an asset allocation methodology where we suggest. We also try to apply mathematical models on how to include it into an asset allocation. And I think we're going more and more in that direction. Maybe I pause here. I think it's not a natural cut, but in the interest of time, that we also want to leave room for some questions, we said.